Hello and welcome to the CNBC-TV18 special. I'm Shereen Bhan, and on this cold, foggy winter morning in the capital, we're joined by Gita Gopinath of the IMF. Gita, thanks very much for joining us on CNBC-TV18. It's good to have you back.
Thanks, Shereen.
Well, I noticed that you're on Twitter now, and did you feel the need for this? Because economic policy and foreign policy is now all sort of being dictated on Twitter.
It did feel like I needed to be on it. I held off for the longest possible time, so I'm a late entrant. But it certainly, there's a lot of important conversations happening.
What's the experience been like over the last 24 hours?
So far, so good. I think it's been fine.
Okay, since you're here in India, Gita, let's start by talking about India, and then I'll talk about the global economy. You've been meeting with government officials, you've met with bureaucrats as well. What's the sense that you get on whether we may have bottomed out? Is this the worst that we've seen as far as GDP is concerned? Because you're also on record to say that the fall in growth in India has been one of the big surprises, and that the IMF will also revise quite significantly its forecast for FY20 in January. Now, we've just seen Moody's put out its report on India, cutting the FY20 growth target to 4.9% versus 5.8%. So how significant is the cut from the IMF likely to be?
It has been a surprise. We were expecting a slowdown in the first two quarters of this fiscal year. And the expectation was that there would be a significant recovery in the second two quarters. Now, looking at some high-frequency indicators, we're not seeing that yet.
Okay.
And that is what is leading us to reevaluate our assessment that we put out in October. And like I mentioned, we will have a number in January, which will be a significant downgrade from what we reported in October. I don't have the exact numbers at this point, but January 20th is when it will be out. The authorities of whom I've met, who were very nice to give me their time, are working on the problems. They're thinking about it. Some of the issues are not very easy to solve very quickly. So, the issues with the banking sector, they tend to be long run. This is not just about India, but they tend to be long run more globally. In addition, in the case of India, there were certain institutions that did not exist that had to be set up. Right. So with the whole new insolvency and bankruptcy code. So then that adds further delays because there is uncertainty about how resolutions will work. There is uncertainty, and when you're thinking as a bank and you're trying to figure out whether you have adequate capital, you have to figure out what the value of your assets are. And if at this point it's unclear what the value is in terms of if it goes into resolution.
Right.
So there are uncertainties around that. And so you certainly see what looks like a reduction in bank risk appetite at this point. And that's showing up in slowing credit growth in India.
So would you worry then about consumption as well? Because so far the consumption side of the story has held up, and it's been the big problem has been on the investment side. Would you now be concerned about the consumption side of the story as well, given what you say about bank credit?
Consumption growth has slowed, and there are two factors to it. One piece comes from the farm sector, so rural income growth, and that has dampened consumption spending, and that's an important factor. A second piece is with the NBFCs that we're sort of financing for consumption spending, and that too, it hasn't cleaned up yet, and so that's the second source of the problem. Another important thing I should mention, the reason that this has been a bit of a surprise in terms of the growth numbers is that if you look at, for instance, business sentiment indicators, they held up quite well. And then in October, November, you saw a pretty steep drop in business sentiment. Now, that's hard to predict. And that's another feature of what we're seeing right now.
Speaking of, and you talk about this surprise, but the other surprise that people are also trying to grapple with, and the ordinary citizen is saying, look, if the economy is in poor shape, then how do we explain the stock markets, which are at record highs? Touching a record high practically every single day. What do you make of that? One explanation that we got from Credit Suisse yesterday was that 1/4 of the BSC 500 market capitalization is not necessarily linked to domestic GDP. So how do you explain this divergence that we're seeing between the macros and the markets?
So this is a phenomenon that's there in some other countries too. In the US too, though it's a strong economy. But if you look at the way the stock market is going, it's going gangbusters. Right? I mean, so there are two things that go into stock markets which can disconnect it from what's going on right now. One, of course, is a forward-looking variable, and so the expectation of things looking up next year would give you reason for stock prices to go up. The second is the denominator, which is the discount factor, interest rates, borrowing costs, and with the monetary policy stimulus that's in the system, that has also reduced it. So the combination, and of course the third factor, which is there are firms that rely on external finance, external environment, and that can also play a role. But again, it is the fact that this is a more forward-looking indicator tells you that there is some optimism that remains.
But how do you then explain that in light of the fact that you yourself are saying that for FY20 the IMF is going to significantly downgrade the growth forecast?
The stock price is a present discounted value of the entire future stream, so it goes well past that.
Okay. Gita, let's talk about interest rates since you brought that issue up. And while we have seen the MPC cut interest rates by 135 basis points, and we have seen some of that being transmitted into the system as well, the view is that interest rates in India, given where nominal growth is, continue to be extremely high. What's your own assessment on that?
So there are two pieces to it. One is, like you said, there has been a significant amount of stimulus that's put in the system, 135 basis points. The pass-through in 2019 has actually been lower than in the previous years. And again, that is a piece that needs to be rectified. And next, in general, monetary policy works with lag, so you expect to see the effect showing up more in 2020. So there is significant stimulus in place. I believe, while on one hand you could say, we're looking at the economy, you would want to maybe have more stimulus in there. I think another important indicator to pay attention to is inflation expectations.
Right.
And inflation expectations have edged up, quite significantly in the last couple of months. And that could be a reason maybe to pause.
Which is what the MPC has done. But, and I guess the RBI governor is saying very clearly that this is just a pause and they will evaluate on the basis of what perhaps happens in the budget, whether there is headroom now for the MPC to act further on rates. What would your expectation be, given the fact that we're already seeing this monetary stimulus? We've also seen fiscal stimulus by way of a corporate tax cut. What would be the expectation now in terms of other measures for fiscal stimulus? A personal income tax cut is what is being debated currently. Will that work? Is that necessary? What do you think?
I think it's very important for India to stick with its fiscal consolidation goals. The FRBM is an important target that the government should keep in mind and should work towards. If you look at the issues with demand in the economy, it's not government spending. In fact, if you look at the last couple of quarters, most of the growth has come from government spending. What needs to be revived is private sector demand, and that requires addressing these issues that are in the banking sector. I think that's an important piece of it.
So if you say that fiscal deficit, deviation perhaps is not warranted at this point in time, because again, the clamor to deviate, even whether it means going to 4% or, that's the expectation that the market is also working with at this point in time. Do you believe that, 0.5% deviation would be acceptable? Would that be necessary given where we find ourselves in the growth path?
I mean, from our point of view, we think it's very important for India to signal its commitment to fiscal consolidation. The borrowing costs are high. That would be one way of bringing borrowing costs down. So it has to signal that. Now, the details will matter about how exactly, the different pieces of expenditure is being assigned. But secondly, I think there's a lot of space for increasing revenue mobilization. Right? The GST revenue mobilization has not come in the way it was expected. So important steps in that direction would have to be taken to raise revenue
Which
mobilization.
means hiking rates or just better compliance?
That would require streamlining, better compliance, yes.
Okay, streamlining, you mean reviewing the rate structure that we currently have? Do you believe the current rate structure is too complex?
I think it would help to simplify it with maybe a couple of rates. But again, the details